Imagine you are building a real estate portfolio, diligently collecting rental income, and seeing your investments grow. You might wonder, how can I optimize my financial position and reduce the amount I owe at tax time, even when my properties are generating revenue? Rental property taxable income is significantly reduced by depreciation. This allows real estate investors to offset a portion of their gross rental income, effectively lowering their net taxable income without actually spending money. It is a powerful non-cash deduction that can transform your investment returns. The core reason for depreciation lies in the concept of wear and tear or obsolescence. The Internal Revenue Service, or IRS, acknowledges that buildings and their components have a finite useful life. Over time, they naturally lose value. Depreciation is simply the accounting method used to expense the cost of an asset over its useful life, rather than in the year it was purchased. Importantly, only the building and other improvements can be depreciated, not the land it sits on, because land is considered to have an indefinite useful life. For residential rental properties, the IRS generally mandates a straight-line depreciation schedule over 27.5 years. To leverage this benefit, you calculate your annual depreciation by taking the cost basis of your building, which includes the purchase price minus the land value plus any eligible acquisition costs, and dividing it by its 27.5-year useful life. This amount is then subtracted from your gross rental income. For instance, if you have a property with a depreciable basis of $500,000, you would deduct approximately $18,181 per year from your taxable income. This deduction directly reduces the income on which you pay taxes, which can lead to substantial tax savings each year. Savvy investors can also explore strategies like cost segregation. This involves identifying and reclassifying certain components of a rental property, such as landscaping, carpeting, or appliances, into shorter depreciation schedules, often 5, 7, or 15 years, instead of the standard 27.5 years for the entire building. This accelerates depreciation deductions, providing larger tax benefits in the earlier years of ownership. However, it is crucial to remember that upon selling the property, you might face depreciation recapture, where some or all of the depreciation previously deducted is taxed at ordinary income rates, though typically not exceeding 25%. Understanding and properly applying depreciation is more than just a tax trick. It is a fundamental pillar of real estate wealth building. By methodically reducing your taxable income year after year, you retain more of your cash flow, which can then be reinvested into acquiring more properties, paying down debt, or simply building your personal wealth. This strategic financial planning helps you maximize the long-term profitability of your real estate investments.